Or about 0.5% lower on the Nifty Bank, 55,980. You got the mid-cap index, which is down about 0.5%. The small-cap index is lower as well. And this is the opening rates. I mean, it's a pretty well-behaved screen all told, with just 0.5% cuts, and actually lesser if you look at the broader market. Small-cap index is down just 0.33%. The mid-cap index is down about 0.4% as well. Market breadth, though, is negative. So 1,270 stocks are lower, 400 stocks are higher, but this is just the initial first 30 seconds actually. The heat map up on your screen, bulk of it is down and some of it is higher, about 5 or 6 names are up in the green and everything else are lower. I think this 100-point cut is also coming through with because of pressure on IT names, which we will look at with some of these individual stocks coming up as we go along. Surabhi.
Bunker busting bombs on Iran from the US. I mean, the way that headline read, this could be just any given day, right? So markets are very, very different animal, at least in this phase. 150 points lower on the Nifty. Let's talk about the stocks then. Infosys, HCL Tech, Wipro, Tech Mahindra, all the stocks are down. So it seems that the read-through from Accenture, the market's choosing to pick up the more cautious side of it. The fact that consulting revenues are lower, the fact that forward bookings, the new business that they're booking, that's on the lower side. So not too much of enthusiasm over there. Let's see what else is weak. HUL, Hindalco, Shriram Finance, Bajaj Finance. These are some more names on the way down. Reliance itself is down about 0.7%, at least at this point in time. Coal India is also lower. On the upside, Nestle, BEL. BEL announced some order wins over the weekend. That's the only one really. ONGC is up because of the slight up move in crude oil prices. Speaking of crude oil, OMCs are not, it's not like they're collapsing or anything, hardly anything. 0.5% down on oil marketing companies. HPCL, BPCL, IOC down about 0.5% each. It's pretty much about it. 150 points lower on the Nifty. Mid-caps also down 0.5%, Nigel.
Well, that's right. You know, Northern Arc, last week we saw this large trade that took place at around 200 rupees or thereabouts. Today as well, there's quite a big volume taking place out there, and that stock is up by close to around 3.5%. So Northern Arc is a stock that's on the radar. It's up close to around 10% from last week's lows. Small finance banks, Utkarsh, Equitas and Ujjivan, all of them higher in today's trading session. So good up move is what we're seeing out there. SCI, that's another stock that's done well. That one, in fact, is up close to around 2% or thereabouts. So good up move is what we're seeing on that name. And another smaller stock, Kerala Ayurveda. You know, the very, very large equity actually has changed hands. So I'll keep an eye out on that one. Close to around 18% equity changing hands at around 470 rupees. The stock is up close to around 15%. A small market cap, only 600 crores, but very, very large equity. Not too sure what's going on there, but we'll keep an eye out for details on that particular. Now up close to around 20%, 17% equity change hands on that one.
Just one more point on the diagnostic companies. Remember, Ekta was telling us Amazon's entering the space. So there's bound to be some disruption, some worries, but stocks are down 2%, not too much. Dr. Lal and Metropolis, slightly lower.
Absolutely, and you know, we'll come back to some of these prices, etc., as we go along. But for now, it's 0.75% down, 24,930. The Nifty Bank is fit for about 55,930 as well. Pankaj Murarka is with us, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, of course, is a long-term bottom-up stock picker. I don't know how much geopolitics is clouding his mind. Having known him for a while, I don't think it is, in a very large way at least. Pankaj, how are you thinking about the whole situation? I mean, actually, markets around the world, equity markets especially, are largely unbothered with what's happening. Even markets in that region are unbothered. How would you look at where we are, and what are the dominant drivers according to you from here?
Morning, Prashant. Yeah, I think, Prashant, on this conflict over the weekend and the US strikes, I think markets are largely drawing an inference that this escalation will remain one contained within the region, so largely in Middle East, and probably there will not be a spillover to the rest of the world. And a large part of my understanding is a large part of transmission of this crisis, if we call it one, is going to be essentially through one, higher energy prices. And we've already seen oil prices up by almost 20% from $65 to $78 or so. So they're probably pricing a risk premium for this crisis. And secondly, probably through lower risk appetite. But I don't think so that the lower risk appetite as far as the risk assets is concerned is setting in globally, because the underlying economic growth momentum in across US and some of the Asian economies, or I would say global economy remains fairly strong. So investors probably are taking a belief that probably this crisis will remain contained. They still believe the escalations will not go too far in terms of Iran exercising some extreme options, and probably a short-lived one. And to that extent, the larger part of transmission is through energy prices, which has some impact on India. But I think India can still deal with it, given our strong external balances. Overall, on the economy, I think one thing clearly that stands out when you talk now, how do you think going forward from here? I think India is in a situation where we are very extremely resilient as an economy, and I would like to draw your attention. The finance minister had written a piece in one of the business newspapers a week back, where she highlighted that all the 5 balance sheets of India are very strong, which essentially is government of India's macroeconomic fundamentals are very strong. The external balances with our forex cover and import covers are very, very resilient. Corporate balance sheets and bank balance sheet in India are very strong. I'm seeing such healthy corporate and bank balance sheets in India almost after a gap of 20 years at the same time, which effectively means there is significant capacity on part of corporates to invest and on part of banks to lend. And finally, the household balance sheet, your and my balance sheets are extremely strong in terms of ability to spend. So combination of all of this means that in an environment globally which is extremely challenged, probably India comes across as one of the most resilient economy with very stable growth. And I think that is what driving markets at this point of time, I think so. And I think that is what really sets India apart from a lot of other economies in the world which have their own set of challenges. So sum total, the view on markets still remains positive. I still think that Nifty index can do a low teens kind of a CAGR returns from here over the next 1 year, over the medium term, over the next 3 years. And probably it's someone like us or for investors who have a medium term perspective, it makes eminent sense to remain extremely bottom up focused and focused on picking right stocks and probably not letting some of these macro headwinds and news flow overplay on your investment decision or portfolios.
Hi, Pankaj. Good morning. Good to see you in. So you're sounding reasonably optimistic, actually, on prospects within India, which is good news as well. It appears that things should work in our favor. Earnings should be better. Earnings growth should be better. And actually, our markets have been quite resilient, going by all the cues we've seen in the first half of the year. I think you briefly alluded to the last time around, you're expecting consumption to pick up. And you're actually taking a contra bet. I think you were quite positive on staples. Tell us more. Does that call hold on?
Yeah, Nigel, morning. Yeah, absolutely. That does hold on. I've been saying that at a $4 trillion economy that India is now, and 60% of this economy drives its growth from consumption, so which effectively means our aggregate private final consumption expenditure by itself is the 8th largest economy in the world at $2.4 trillion. Companies which can execute well can derive significant growth out of this ecosystem. So I clearly think that as it is, I think there'll be we're coming out of the long-term growth, last 15 years growth of our aggregate consumption is about 11%. Last 2 years, the growth has been about 6.5%. So I think I firmly believe all the stars are aligned for a cyclical recovery in India's consumption sector or a consumption basket or final aggregate consumption expenditure by households in the second half of this year and building into the next year. So we are in for a very healthy cyclical recovery. And more importantly, companies which are executing well and strategizing and executing well can grow at a much higher rate. So yeah, my whole hypothesis on that is one space where I find, valuations have now normalized from where they were far in excess or pretty expensive at the time of COVID last 5 years. Consumption or consumer as a sector, companies in that sector by and large underperformed big time as versus the broader market indices. And also earnings growth has been lagging. I think valuations have normalized and earnings growth will accelerate. So probably I think next year, consumer sectors will actually grow higher than the aggregate index earnings growth. So I certainly think that one can comfortably make mid-teens to high-teens kind of returns in some of the consumer names, and with the kind of safety and security they offer in terms of downside protection, both to earnings and valuations, I think for low-risk investors like ourselves looking at medium-term high-teens kind of returns, at this point of time, that sector looks very attractive.
Okay, consumer. You'll look out for that. Point noted, Pankaj. Also, by the way, I'm looking at some of the early movers and keep a watch on some of the defense names because they've already started gaining some ground. Not all, but a little bit. Garden Reach Shipbuilders, for instance, some of the private sector names like Paras Defense I had seen earlier, even Idea Forge. Some green on these stocks, while the overall market is a little subdued this morning. Pankaj, so yeah, what about this space? The news flow refuses to die down when it's defense. But the question is, I mean, whether it's too late from a stock point of view to be an investor now. What's your sense?
Absolutely. I think it's very clear that stocks have done phenomenally well, given that now there's a new defense doctrine that India has had with our own challenges with which we faced with our neighbor a few weeks back. It's a given that India's defense spends are going to increase significantly, and probably for all companies in the space, the opportunity is very significant. Yet I concede that the valuations in the space are extremely rich. Any defense company now trades at multiples, which it's difficult to justify this defense companies now basis near-term earnings multiple over the next 2 or 3 years. So clearly, markets are pricing in a sustained high growth in terms of earnings and cash flows for these defense companies over a very long period of time. I think some of these companies will deliver, but it's very obvious that when these kind of things happen in a particular sector, and we have seen time and again repeatedly in history of market, that many of these companies will not live up to the expectation. So I think it's very important for investors to make choices between the stocks very carefully. At this point of time, because a lot of this is driven by macro narrative, it's very difficult to figure out which companies will be able to execute well and deliver, and which will not be able to. From a value-oriented investors like ourselves, we have taken this opportunity to actually take money out of defense stocks. So, and it's very difficult for us to own stocks where we cannot justify them on the near-term valuations over the next 3 years or 4 years. So I think anyone being invested into those stocks from a more fundamental perspective will have to look at earnings and cash flows over much longer time horizons. Stock price behavior is more a function of momentum, and momentum. Investing into momentum in stock price is always very risky because momentums can fade. They can come very quickly, but they can also fade equally quickly. And the stock price swings on either sides can be very, very sharp. So I would urge that investors should really think through in terms of what they're expecting from these stocks from a longer term perspective. And as I said, from a value investor like ourselves, we are actually sold into our holdings. So we do have very little exposure to defense at this point of time.
Yeah, no, absolutely. And we've heard that, earlier as well. The tailwind is there, the spending thrust, etc. is there, but markets price everything so quickly, and maybe a lot is already priced here as far as the entire defense space is concerned. Pankaj, any new areas of interest to you where a lot of new sectors, right? Many are actually in the unlisted domain though, but new industries developing, segments, etc. coming about.
I still continue to feel pretty excited about, internet companies in India, because I still think a lot of these companies are growing at a pretty healthy or high rate, if I may say so. So slightly more, the point is, Prashant, we are dealing with the most expensive equity market in the world. And we are in the 6th year of this bull market. So it's a very matured bull market. In a matured bull market, in the most expensive equity market in the world, it's difficult to find value on the table. So obviously, one way of playing it is one can go down the curve, which effectively means you end up compromising portfolio quality and buying poor quality companies. My experience of doing that way back 20 years back has been very bad, and I've burnt my fingers very badly. So I'm extremely cautious of not committing that error. And then the other way of playing around in these markets is you take a slightly more longer term horizon in terms of where you can find earning surprises, or where growth is underpriced in that sense, while keeping the quality of business and quality of management intact, kind of a thing. And one space where I still find that growth can surprise positively is the internet sector or India's internet ecosystem, because I think their growth, meaning while their markets are pricing in growth, I still think in the medium term, long term, given India's growth dynamics, growth can surprise there positively, or can be much higher than what market are pricing in. And my experience of investing into high growth businesses has been, we tend to, as analysts, we tend to overestimate growth in the short term, but we do end up underestimating growth in the long term, where we underestimate India's long term growth potential and growth trajectory for many of these companies. So if you go back to a lot of these companies which are large, probably when we forecasted growth for these companies 20 years back, we did underestimate their long-term growth potential. So I find a lot of those opportunities in internet sector, and from our point of view, we're trying to focus more on slightly more longer term while not going down the quality curve.
Sure. Okay. All right. Point well taken, Pankaj. Thank you very much for being with us this morning and for giving us all of that perspective. Good speaking with you today. Just a quick glance back at the market. We are still down just under 1%, 0.8% lower. 200 points is the cut. And actually, within the Asian region now, we are among the weaker markets because other large markets like the Hang Seng, like Japan, they're actually down less than 0.5%. So let's see. Right now dealing with a 200-point cut. By the way, even if you're looking at the dollar, or if you're looking at the US 10-year yields, now that rates are coming in and people are back to trading, even the dollar index is just about 99. So there's been no major reaction, no matter which parameter you're looking at, to assess the market's interpretation of the risk. Let's then get another interpretation from someone who's a veteran, who's seen a lot of these cycles play out in the past. Prashant Khemka, founder of White Oak Capital Management, is with us. Prashant, good morning. Thanks so much for joining in. A trade war, a real war, localized conflicts, and now direct US bombers in Iran. Who would have thought that you throw all of this at the market and yet it turns out to be so very resilient? What do you make of the way the market is interpreting the rise in risk in the last 2-3 months?
Oh, certainly. Survi, first of all, thank you for having me here. Now, almost at all times, if you look at historically, the events might have been different, the nature of the events might have been different, but we've been interacting for so long, right? It always feels like we are in an elevated risk environment, almost always. So first of all, I don't want to say that we are in particularly, risk-prone environment. Tariffs, they were announced, but market very soon realized after initial pullback that they're not going to stick. Markets always, as you know, see ahead of what then transpires. The markets can see beyond horizon. Just like I keep going back to COVID. Market bottomed March 23, where there were less than 1,000 deaths or less than 1,000 infections actually in India. And then we had obviously so many, because market could see beyond. Nothing, according to market, all this is not going to have any material or lasting impact. And both are important, neither material nor lasting impact on the cash flows of the corporates. And that market seems to be quite certain about. And hence the market, with a few points here or there, a few percentage points here or there, has recovered with each of these hits that we've seen.
Prashant, that's my question. I know the market's wisdom is the supreme. In my 20-year reporting career, the only time I can think the markets maybe got it wrong, couldn't forecast the future accurately, maybe it was a global financial crisis, right? Markets kept rallying. They had no clue the kind of storm that was waiting on the other side. But in the present environment, would you go with the market's wisdom that whether it's the trade war or tariffs or geopolitics, to borrow Prashant's phrase, Teflon coated, and that's the way to be?
Yes, I think the worst is behind us on each of these events, if you will. So tariff, we all can agree that worst is behind us, right? Maybe there would be ripples of the main announcements and the main event in each of these cases, but it seems like we can always be surprised, and I'm certainly not a geopolitics expert, if at all an expert on anything, but from what I can make out, it seems like we should have a relative phase of calm now on the geopolitical front, especially when it pertains to Middle East. Once US gets involved, and I'm not saying who's right, who's wrong, because I'm not that learned on the subject matter to make those conclusions, but just purely from the market's perspective, I think the worst of this geopolitical event, the most recent geopolitical event, is behind. I'm somewhat surprised that the Indian market's not up today. Not that we have any short-term perspective on these aspects. As you noted, the other Asian markets are not impacted much. So the Indian market impact is a little bit maybe not related to war, but this geopolitical event, but it's coming on the heels of it. Maybe it is related to, but I don't see much of a lasting negative impact of what's happened over the weekend.
Right, absolutely. Prashant, by the way, are you speaking with you? You're coming to us from Mumbai or Dubai?
Right now, Singapore.
In Singapore. Okay, all right. By the
If
way,
it's Dubai, maybe he sees. You would have wondered if he's seeing the missiles up in the air, no?
That is why I asked.
I'll be in Mumbai next week, though, for a while.
Oh, okay.
A lot of flights, by the way. Shireen came back from the US last night, 18-hour flight.
Yeah.
My daughter came back from Germany yesterday. And again, I mean, actually, you're on flight radar, tracking flights, and it's like, there are real sort of, implications as well. Interesting conversation, Prashant. The other factor, of course, is just fatigue, right? Conflict fatigue. I mean, of course, it's just conflict. As you said, it began by saying, always in a heightened state of risk. So beyond a point, you just kind of, you just shrug your shoulders and move on in a way. I think that's also maybe one way to describe it.
Very true. See, Russia, Ukraine, in recent years or even decades, I would say Russia, Ukraine, which started, I think, 22, right? Yeah. So it's 3 years old now. Yes, there have been definitely economic impact of that war. But it does not cause bankruptcies, widespread bankruptcies and whatnot. To Surbhi's point about GFC, I think what the market really worries about and would take a huge hit and cause material lasting loss is there are widespread bankruptcies, as was the case, and also the risk of larger widespread bankruptcies in case of GFC, and as was the worry initially with COVID. And that's why, because nobody can move out, all the travel companies would go bankrupt, all the airline companies would go bankrupt, and the banks would go bankrupt, and so on and so forth. And hence we saw 30% kind of hit. But these events, it's hard to make the case that there would be widespread bankruptcies around the world. And that is why I think, it's a risk that is consistent with what you call it, Prashant, the heightened state of risk environment that the market, we have all been, from a geopolitical perspective, at least for the last 3+ years now. And that's a beautiful material impact on corporates.
Prashant, I just want to compliment you. I think that's a beautiful point and so well put. Sometimes you forget this. And you're right, because with whatever is happening, there is no bankruptcy or a financial systemic collapse, which is what caused 2008, right? Yeah. And it reminds us once again that for markets, at the end of the day, I mean, as you can argue it's inhuman, sounds a little brutal, but at the end of the day, it boils down to profit, whether it's there or it's not there. So I just wanted to compliment you on a point well made.
Thank you. Thank you. And the bankruptcy is so important because, see, if there's a hit for a year, like COVID was a hit on the P&L for a year, but next year things normalize. If there's bankruptcy risk, then there's no time to normalize. Equity shareholders get wiped out. Yeah. And that is the distinction between a short-term hit and a bankruptcy.
Prashant, I always tell my co-anchors, because my career started after GFC. I haven't seen GFC because my career started after that. And hopefully we'll never see it as well because, markets are far more mature. As you said, corporate balance sheets itself are in far better shape. And I believe that, in fact, the retail investor is maturing as well. That's the hope, that we don't see something like what we saw in 2008. That said, Prashant, things looking good from an India market perspective. Give and take everything. I think, there appears there's a longer runway. One problem is when the markets are so strong and liquidity is so solid, you see a lot of supply of paper. Does that worry you, when promoters come and say, I'm willing to sell $100 million worth of shares, and will you buy it? Or do you believe that this market is, is far more mature? this is actually a positive sign that, there could be so much of money taken off the table, and ultimately some of this money gets rerouted back into the markets itself. Your take?
Nigel, I think it's very healthy. I mean, one of the real positive, real impact, one amongst the many positive real economy impact of, you can call it bull market or healthy markets, is that capital gets channelized into real economy. So the fact that companies are raising money to put up, and just over the last few days, several of them have done so, right, Nigel? So that's very healthy. The mutual funds, domestic mutual funds, foreign institutions, and other segments, prop investors, they're all basically channeling financial capital into real economy. And the markets are the most efficient place to do such capital allocation. And that's the most beautiful and most rewarding part to the society, rather than just stocks going up and down, is the channeling of this capital towards productive uses. Now, 100% isn't going to be productive in any endeavor. 100% is not the success rate. But in capital market history, if in my assessment, it is fairly high degree of success rate. Yes, there's nothing wrong if promoters also, obviously, as investors, we have to evaluate what signals are these managements providing when they're selling down their own stake. But it's not necessarily always wrong. Many a times, these promoters have 100% of their net worth linked to the company, and it may be prudent to take some off for the sake of family or for other purposes. So each case has to be analyzed differently, but the overall fundraising for corporate purposes is very healthy, and for individual purposes also. And for both purposes, you have to evaluate case by case. On the whole, I think of it as a healthy phenomenon.
So then, Prashant, it gets us back to the basic question. Now, we've discussed enough why the market is not falling and why we don't need to worry too much. So then let's round it off with the usual question. We come back to the argument of valuations here in India. Which pockets still look okay to you? In the past, when we spoke on earlier shows, including on Market Cafe, you were looking at some pockets of mid-cap pharma, some mid-cap IT. Of course, you've been liking internet stocks. So still sticking with those themes. Anything new ideas?
Well, I'd say yes. All those are still places, areas, and they structurally tend to be areas where we find good investment opportunities, financials, and in financials, particularly, larger caps amongst banks, but there are a lot of NBFCs where mid and small cap opportunities are there. Healthcare across board, but more particularly mid and small caps. IT services, more particularly mid and small caps. Industrials, selectively. Consumer in consumption, mid and small caps. Obviously, alpha opportunities often would come in mid caps and small caps, though in large caps also do provide opportunity to generate alpha. So those remain the same. If there is anything since we last spoke, Surbhi, and while it is a theme that has played quite strongly in the markets over the last 2-3 years, I think just the events of the last 2-3 months, particularly the India-Pakistan conflict, does merit a much closer look to all defense names and see if there is value there in the context of, I would say, a material change for the defense industry or the sustainability. You can say the change has been in place for last 10 years, but the sustainability of the change can have much longer legs to the events that played out over the last couple of months.
All right. And I think you guys are, sort of looking at niche manufacturing names, etc. as well, right? Which kind of feed into that broader defense theme. And we discussed that on the Editors Roundtable with your head of research, of course. Thanks very much, Prashant. Appreciate you joining us. And it's always a pleasure speaking with you on this. Gargi Chaudhary is Managing Director, Chief Investment and Portfolio Strategist Americas at BlackRock, and she's with us here in our studios to take us through what she's making of this entire situation. Gargi, great to have you with us in the program. Thank you very much for your time. We've had guest after guest, and we've been talking about this general sense of calm in markets, largely unbothered. Oil prices are up small, equity markets, of course. They're not the first port of call when you have things like this. It's oil, but it's not showing up in oil in any big way as well, what's happening. And we were also wondering earlier, it's not showing up in bonds, it's not showing up in the dollar, which are traditional safe havens. What do you make of it, the market reaction?
Not even in gold. Looking across asset classes.
Right.
It's just almost BAU.
Yeah, so good morning. Thank you for having me. And absolutely, to your point earlier, it's been a little alarming to see the news headlines, obviously. But at the same time, when you look at price action in markets, I think they're telling us something. And I think what we should take away is that historically, geopolitical events, as hollow as it sounds to say this, obviously from a human impact, historically, they have not had a longer-term, sustained impact on equity markets. So when you look back 20 years, 5 years, 3 months, all of the geopolitical events that we've had, if you look at the US global equity market response a month or 3 months out, you've seen that geopolitical events have not really had a role to play. So I think what we're seeing now is just a much more efficient version of that. The markets aren't even really doing the initial sell-off in a meaningful manner. They're looking ahead to earnings, which are robust, financial conditions, which are pretty supportive, especially in emerging market economies where there are rate cuts abound. And in the US, I think the market's looking ahead already to this idea that earnings still remain very, very solid. And once again, we think geopolitical events will eventually be looked through by the markets. I will take a little bit of the other side on your point earlier, Prashant, that you made on oil prices. A little bit more muted, especially after the weekend news. But if you look back from May, we have had a significant jump. So that 26% or so rise, that's not nothing. And I think that's the big event that the market's going to react to, especially if there's anything that happens with the Strait of Hormuz in the weeks and days to come.
So, I mean, given what you've said, what the previous speaker is saying, it just kind of reminds us, and it's good to sort of have that, that there is no immediate corporate impact, no immediate financial impact, and that explains the market's reaction. So can you now expand on one of the points you made, which is robust U.S. growth in corporate earnings?
Yeah. Because
there, the one sword that's hanging is tariffs. Now, in the midst of all of this, we've forgotten that we're very close to July 9 as well, right? But we're there. And we don't know what those final tariffs are like and what the implications of that will be. Your thoughts?
Of course. So there are a couple of things here as well. So number one, there's already been a significant amount of tariff de-escalation. And I think the markets have absolutely responded to that when you look at the price action from the beginning of April to basically now. We were sort of getting to a point where expectations of tariffs was in the mid-20s. Right now, that's landing somewhere. The landing zone is, call it between 10 and 15%. Significantly higher than where we were in 2024. But given what we had sort of thought it might be, it's still, there's been some de-escalation. While that's been going on, I think what the market should pay more attention to is that corporate earnings have actually been a lot stronger. So when you look at Q1, and obviously Q2 is upcoming, but when you look at Q1, earnings growth was almost double of what was expected. And that the diffusion index of that was very broad. That came across, it wasn't just the Mag 7 names. It was across different sectors. And I think that alongside the fact that many investors have been over-allocated to cash, have been sitting on the sidelines because they've been nervous about this volatility as a result of geopolitical risks, as a result of tariff risks, uncertainty around future fiscal policy. Some of that money is beginning to move back into US and, frankly, international markets, which is another big theme that we've begun to see for the course of 2025. So earnings have been strong. Growth weaker than 2024, but we're not looking at a recession in the US anytime soon. And at the same time, we have a Fed that's sort of signaling that they're still willing to entertain about 2 cuts this year.
All right. Hi, Gargi. Good to have you in the studio.
Great to be here.
A quick point with regard to Brent crude prices. It's hiked up, as you said, by $15. At what level will become a bit of a worry for India? Because, normally if you saw such a big spike, Indian markets would have been rogered. That's not really happened this time around. So at what point of time do you think it's a worry? And the second part is on the dollar index. Consensus seems to be suggesting that the dollar index has made a near-term peak and will correct from here on. What's your take?
Sure. So I'll talk about oil prices first, of course, especially as it pertains to Indian investors. So I think that it's not the level it touches, but the sustained amount of time that it can stay there. So obviously, if we have this left tail event of the Strait of Hormuz getting shut down, we all know that's 20% of global oil supplies. India, China, Europe being countries that are net importers of oil, of course, that's going to be GDP and consumption hampering. Yes. But the question is, how long do we stay at those $75, $80, $100 levels? If we stay there for a period of time, that is where it becomes a consumption worry. If it touches there and then, it shuts down and then reopens, if it touches there, but then it de-escalates very quickly, I think that's going to be quite a different outcome. So I think both are important. Obviously the level, but more important than the level is the change.
Yes, okay.
And then the second point around the US dollar, I think there are two things to think about here. One is more around the, medium-term impact. I think there are quite a few things that are pointing to a decelerating dollar trend. Number one, international markets being a source of asset allocation for our investors across the world again. To the extent that many investors were only thinking about US markets, this is a year that has shown why you need to be diversified globally in countries like India and Japan and broadly in Europe as well. So the idea of moving away from the US, and then I would say secondly, many international investors in the past that haven't hedged are now beginning to hedge more meaningfully. That is another pressure on the US dollar. So both of those, I would say, are driving and will continue to be a driving force lower. However, I want to be very careful as to what that may or may not mean for structural views. This is not about USD not being a reserve currency. If you look at 90% of FX transactions, 40% of global trade invoicing, about 70% of global payments, it's still in US dollars. So we're not losing the reserve status. This is more of a structural view or a cyclical view to slightly lower levels than here, because the dollar, even today, with the move year till date, is still an expensive currency. So I think we can see a little bit more of that.
There is also that inherent tension, right? I mean, the US and Trump administration wants the dollar lower, but they still want, in a way, the dollar to be right there, to be bought in adequate amounts. So, that inherent tension is there. That reserve currency point, that goes against the view that dollar should be lower, a lot lower. In a way, right? There is that...
Everyone should use the dollar, but the dollar should be lower.
Should be sure. So it's a...
I think it's balancing what you're trying to achieve. If it's trade deficit you're worried about, if it's budget deficit that you're worried about, I think it's thinking about all of those together and the role the dollar has to play. I will say there's a huge amount of focus on the unwind of US exceptionalism. So that's a narrative that's been out there, and you guys have talked about it. I think what's more important is what is the fragility in our fiscal policies in the US? What does that point to? And I think that's what the dollar is reacting to. If we're going to have a higher and higher fiscal deficit, can that support a stronger dollar? And I think that's why we've been telling investors a lot to stay away, in the US especially, from the very long end of the bond market. So I think that those are the ways in which it manifests itself.
Yes, what's the size of the US talking about? $50 trillion?
Yeah, a little bit more. But yeah.
A little bit moving out. I think it's going to be good for the rest of the world, maybe good for US as well. It kind of takes the pressure of US valuations, etc.
I think
it's not the end of exceptionalism. It's just maybe just some
exactly. It's a pause, and I think it's a good way for many investors, US investors included, to think about a diversified portfolio which has allocations to emerging markets, to Europe, and to US.
So everybody benefits. Okay, so let's talk about India. And what do you think of things happening here? Because I think since we last had you in the studio, the Reserve Bank of India has been very, very generous with the CRR cuts, with the repo cuts. And we were discussing this internally, that earlier when we would get a 50 basis point CRR cut, 100 basis point, we'd be like, oh my God, it's crisis time. So it's, RBI firefighting. But I don't know if this is a new age of monetary policy. Just your thoughts on how things are positioned here.
Yeah, absolutely. So the last time I was here in the studio was about, I think, 6 or 7 months ago. We were just discussing one of the things that we talked about or had talked about was just the longer term appeal of India, especially for international investors, US investors that may not have had India as a source of diversification in their portfolios. And more so than ever now, with the pullback that we experienced towards the end of 2024, coming into 2025, especially now with the cyclical turn in earnings in US. I was just looking at some of the earnings revisions ratios now moving up in India, alongside with your point around the RBI giving us a generous rate cut and financial conditions as a result being so supportive. I think those are all great. You've got the valuations, which may not look incredibly amazing, but I think that's always been the case in India. But on the same time, you have a case for a role in the portfolio. You have flows that are turning. We're seeing international investors that had left the Indian markets coming back a little bit. So that's positive. You've got the fundamentals from an earnings perspective, and you've got the macro fundamentals just from RBI being more able to support perspective. So all of that, I think, is short-term great. From a longer-term perspective, the demographic story, the digitization story, we've talked about that at BlackRock a lot. I think those are really beneficial for the Indian markets. And we're constantly telling investors to think about India and China as standalone parts of your portfolio, as opposed to putting it all together as one EM bucket.
Okay, Gargi's making us feel good. The world, global equities, US, and of course here in India as well. So yeah, suddenly the missiles are not that frightening anymore.
Come more often, Gargi.
We would love that.
Thanks very much, Gargi.
Thank you.
Thank you so much for that. Well, with that, we will move on. Lots of market perspective over there. Quick check on the market. Market's actually still down about 250 points, 1% lower for the time being. Probably one of the weaker markets in Asia. And the Bank Nifty is down about 0.7%. Speaking of the Bank Nifty, over the weekend, we had more policy action from the RBI, and they've gone ahead to ease some rules, some norms for small finance banks. Now, the norms in question are the priority sector lending norms, which is where the earlier requirement of 75% has been now dialed down to about 60%. So what does this mean for companies? Let's talk about this with Mr. Ajay Kanwal, Managing Director and CEO at Jana Small Finance Bank. Mr. Kanwal, thanks so much for joining us this morning. So that's really our first question. No longer a mandate to do 75%, now 60%. So what does this additional flexibility mean for small finance banks, including Jana?
Right. So good morning to you and all the viewers. It has been a long request from the Association of Small Finance Banks to see if the norms could be dropped from 75% lower. So I think the 60% is very welcome, and a big thank you to our regulator. What it does do is it allows us to do different kinds of things. So for example, car loans, lending to small corporates, which is probably beyond the turnover levels of MSMEs, two-wheeler loans. So there are many categories of loans which don't fall under priority sector. I think this allows us to do more of that. And it also fits very well into what is known as a diversification of asset book. So if any SFB did think that, his diversification strategy was being hurt by the high PSL number, then certainly now better opportunity to be more diversified. So those are three things that I could mention.
Hi, sir. Good morning and good to see you in. So you have the liberty now to lend to other sectors as well. So could you tell us how do you see things panning out? How do you see your loan book mix changing? Point number one. And point number two is it'll affect your margin profile, right? It'll be accretive. How do you see that pan out?
Right. So first is for Jana specifically. Listen, we are already 70% non-microfinance, and we have been in the affordable housing, business lab, MSME from the last 7 years. So for us, it's a good tailwind to have, but doesn't change any strategy, obviously, immediately. It does help us as we go up into supply chain, into lending to small size, mid-sized companies. Then we certainly have an advantage with this coming in. So that's what will happen within Jana's context. But as you very well know, all SFBs have different asset class diversifications and sizes. So I'm sure others will take bigger benefit of it. We'll probably take a smaller benefit of. But I think it's a very welcome answer for us.
Mr. Kamal, in our earlier conversations, you've always spoken about how Jana is looking to increase the share of secured lending. So just revisit that whole plan for us, and now with a very different requirement on priority sector lending, what, say, a year down the line, what would be your targeted book look like? I mean, how much would it be, maybe auto finance, and how much? Just trying to understand, say 1 to 2 years down the line with this new regulation and your move towards secured, what will the book look like?
So first is, this regulation is also signaling to us more diversification is better. And that supports us quite a lot. We certainly would like to reach 80%, and that is what we have said in the public domain also. We've reached 70% in the last 7 years. We would certainly like to reach 80%. In the balance 20%, of which is largely microfinance business, we would like to put that all under the guarantee program of both CGMFU and CGTMBC. So in a way, you can say that, yeah, we'll be secured 80%, but fundamentally my entire book will more or less be either under guarantee program or a secured book. So that will be a combination in the next two to 3 years at best, depending on how the different things work out. I missed answering Prashant's second part of the question, so I suddenly remembered. See, on the margins, yes, as you do secured, margins will be lower, no doubt about it.
Yeah.
There is a compensating answer when it comes to cost income. So your cost income for secured assets is better. And second, your gross NPS will be better. Yes. So starting wise, small compression in NIMs. We have lived through that in Jana. We were at 10.5, 11% NIMs when we were all unsecured. We're down to 7.7. But then our cost income has shown a big change. And I do think that even if you look at this whole stress in the last 1 year in MFI, we've been slightly more removed from it because the book composition is low there. So it certainly helps in cross NPA and cross income.
What's the AUM growth target this year? Now that you have this slight relief also from RBI, you can look at other segments.
So I must say that 2-3 things have happened very brilliantly in the last few months, probably signaling what to expect. I think the repo rate cut, the CRR cut, a very clear cut, helpful gold loan circular, now the 60%. I think towards the trend is very clear that things are getting easier as we go along. We have signaled a 20% growth in asset, and as of now, we were not changing that. But rest assured that yes, every endeavor that if you could do more.
Okay, so perhaps more than 20% growth of the book this year, given the favorable environment. Got that. Thank you very much for joining us. Short conversation today, but it's a helpful one. Thank you very much. Quickly going back to Mitesh now, take stock of the market, which has been still under pressure. Mitesh, what would you do now?
So, Surya, I was talking about, some kind of support coming in around 24,900. Now we are below that. So we're not taking any long position very clearly, neither on the index nor on stocks. But as long as we are below that, we'll explore some kind of shorting opportunities. And the stocks that I have right now, sell on Birla with a stop at about 29.65 for targets of 2,900 and below. And the other one is a sell on SBI cards with a stop at about 960 for targets of around 950.
Okay. All right. Thanks a lot for that, Mitesh. Just by the way, before we slip into the short break, I want to pull up the stock of Dixon. The low of the day was at around 13,280. As we speak, it's at 14,370. So there was a large trade that took place in the initial moments of trade. And from there, the stock has seen a sharp spike up. So, just keep an eye out on that one. More than 1,000 rupees from the low point of the day. Slip into a short break. Come back. Manisha Gupta will be waiting for us. She'll tell us what's going on in the commodity space.
Welcome back. We've got a new listing, not a new listing, but basically the demerged arm of Aditya Birla Fashion and Retail, the new arm which is now called Aditya Birla Lifestyle, has made its debut. Let's go across to Vinny to understand what is this business, what has shifted to this entity that is starting its listing journey from today. Vinny.
Hi, good morning. So yes, it's starting its listing journey from today. And the price
Vinny, I think Mike. We need to get Vinny's mic back. In the meantime, let me just fill you in. The demerger was announced a couple of months back, and then there was a split. So basically, Aditya Birla Fashion and Retail, from what I remember, continues to have the Pantaloon business. That's the lion's share of their business, plus a lot of other ethnic brands and some of the high fashion brands like Tarun Tahiliani, etc. Those kind of labels are under Aditya Birla Fashion and Retail. The entity that's listed today will now house a lot of the big brands that have led to the rise of, Madura, as it was earlier known, Madura Garments once upon a time. Those are the brands on your screens. Louis Philippe, Van Heusen, Alan Solly, Peter England, all of them have moved to this entity, which has listed today. Vinny, take it over now.
Hi, yes. So in terms of the listing, it's listed at the price that was expected. Motilal Oswal had indicated an implied price also on the record date of 22nd of May. That was at 171. So it's at 167 right now. And pre-open price was also at around 167. Now, obviously, Aditya Birla Lifestyle Brands is something that is housing Mundra Fashions Limited, a lot of brands that come into it, Western wear, legacy brands, growth brand segments specifically. So Reebok, American Eagle, Van Heusen, innerwear specifically something that they are betting on in terms of growth factors for the company going forward. Louis Philippe is also there, Alan Solly is there, Peter England. So these are the brands that they want to work on. More of the brands are coming into this side of the business, Aditya Birla Lifestyle side of the business, and lifestyle brands had accounted around 85% of the revenue for overall the merged entity of Aditya Birla Fashion. So now that has come into Aditya Birla Lifestyle Brands. Now the guidance that company itself had given when this demerger happened, they spoke about targeting around a 13% revenue CAGR growth over the next 5 years for the company, EBITDA margin expansion of around 300 basis points and expecting it at around 11%, and in terms of return on capital employed also of 70+% is what that indicated. This they said previously as well. This is over the next few years is what they're expecting. Now, Bernstein, according to their SOTP valuation, this should have been at around a 185 rupees listing. But obviously, it's below their expectation. But other than that, today's note from Motilal Oswal, they are giving a neutral rating, target price of 190 rupees per share for the company going forward. And that is what we'll keep an eye out on as well.
All right, Vinny, thanks very much for that. That's the update coming in as far as stocks are concerned. Commodities in focus. Manisha, of course, is here. She's been, I think, on top of developments as far as oil prices are concerned. Manisha, we've spoken to a bunch of people this morning, and everyone kind of course, highlighting the fact that oil perhaps should have been up more. It's not, and that's telling.
Oh, yes, it is. And, when you look at the prices itself, we've seen after that knee-jerk reaction, prices come off a bit. We're trading at around 2% on the higher side after the U.S. attacked 3 nuclear sites in Iran. The knee-jerk reaction after the markets opened after a weekend, we did see prices gain up by 5.5%. We saw $81 a barrel. But from there, we've seen easing in sense of markets. And that is because there is no immediate response coming in from Iran after these attacks. Of course, there's a lot of rhetoric and a lot of statements coming in, but nothing on ground. And that's taken the prices off those highs. In any case, if you look at the crude oil prices, we've seen 10% of gains coming on this after Israel launched its attack on Iran a week ago. And 10% on the higher side is still holding. And this is even as there is no impact on oil supplies, no impact on oil exports, and no impact absolutely on Strait of Hormuz as well. So the Brent, as we see it right now, is looking at resistance of $80 a barrel. Interestingly, if there is an impact on ground, we have seen crude oil prices jump up quite strongly in those cases. 1979-80, remember when there was Iran revolution, we did see the crude oil prices triple at that point in time. Very recently in 2011, during the Libya revolution, we did see prices surge all the way from $93 to $130 on the higher side as well. So things do happen when things happen on ground though. What is the worst case scenario that markets are talking about or looking at is if there is an impact on the production, especially coming in from Iran, which is producing at this point in time 3.3 million barrels per day. Apart from that, if you look at the prices itself, we've seen strong gains already come into the markets. As I said, the last 1 week has seen 8% of gains. In last 1 month, we are already up by 25%. And in this year now, we've turned in the positive. 2023 and 24 were negative years for crude oil prices, but 25 clearly in the positive right now. As I was saying, markets are looking at various scenarios on what really could go wrong. For example, Iran is producing 3.3 million barrels per day. It is exporting 1.84 million barrels per day. This was for the month of May. Any changes in this number, you will see the crude prices gain up. Apart from that, the closure of Strait of Hormuz is going to be a very, very important thing to watch out for. At this point, it's only about rhetoric. Nothing has been done. So you are looking at 20 million barrels per day or 20% of global oil flowing through this route even now. As per the maritime reports, around 100 to 120 ships sail through Strait of Hormuz every single day. And those reports continue to be around those numbers at this point. Iran has threatened U.S. bases in West Asia. If something happens there, you will see the crude prices go up. Apart from that, the regime change in Iran also could be a reason that you could see crude prices gaining. We have seen regime changes in major oil-producing countries do lead to crude prices being quite volatile as well. At this time, the spike in crude oil prices has led to a lot of hedging. It's been record hedging volumes that we've seen in the U.S. markets that has gained up by 25% in last 1 month itself. Well, we've seen crude oil prices at $60 this year. So when you're looking at prices at around 75 and between 80, you are looking at prices gaining there. It's interesting on what various banks and brokerages also have been saying. They also have not been major bulls into the market. Citi said that the prices could hit 78 if conflict disrupts 1.1 million barrels per day in sense of Iran exports there. Citi also says that a disruption of 3 million barrels per day within Iran production can take the prices to $90. We haven't seen that scenario emerge. JP Morgan says in an extreme case, you could see prices go up to 120, 130 as well. And that extreme would be Strait of Hormuz being closed. We haven't seen that happen. Goldman Sachs also says that the prices can surge quite strongly. They already see a premium of $10 per barrel in the prices. And an extreme case like a closure of Strait of Hormuz, they also believe that the prices can go to triple digit there. Barclays' view is $85 if the exports are cut. We also have statements coming in from Mizuho Group, which says that in case of a disruption is when you could see prices going up to $85. And there are similar statements also coming in from trading.com, BOFA as well, which believe that de-escalation can take the prices to 65, and if something happens, then up to 85. And that is the kind of range that many of these banks and brokerages at this point seem to be working with.
Okay, all right, got it. Thanks very much for that. So oil in very, very sharp focus. We'll take a break on that note, come back on the other side. And in our special segment, it's the economy. Today, Lata speaks with MPC member Saugata Bhattacharya on the state of the economy under changing geopolitics.
The minutes of RBI's Monetary Policy Committee showed that all members agree growth needs more help while inflation is anyways way below the 4% mandate of the MPC, and hence the 50 basis rate cut, repo rate cut, was warranted to ensure banks have more certainty and can pass on the rate cuts, ensure transmission. However, one member voted against the 50 basis cut and opted instead for a 25 basis cut. Saugata Bhattacharya, the external member of the MPC, is our guest today. Good morning, Saugata. Thank you very much indeed for your time. Have I understood you right that you did not want 50 bips but preferred a 25 bips because you think growth is very resilient?
Good morning, Lata. Thank you very much for having me on your show. Okay, so the first thing I need to emphasize is that I speak only for myself, not on behalf of anybody else in the MPC.
Sure.
So you put it absolutely succinctly. I think given the combination of the really elevated levels of uncertainty that still persist at this point in time, and all signals suggesting that growth impulses remain resilient, I thought that the risk-reward balance of a 50 basis point cut at this point in time was probably not warranted enough. I think a 25 basis point was more appropriate at this point in time, given the path of uncertainty. So again, if you permit me 2 seconds, 5 seconds,
sure.
This harks back to my old April policy statement that there is the inflation trajectory. And remember, there were only 2 data points which were relatively new for the July meeting. One was the reduction in the RBI's forecast of CPI inflation for FY26 to 3.7%, and the growth numbers that came in for FY25, together with the RBI's forecast of FY26 growth at 6.5%. So this gives, to my mind, space for good news rate cuts. There is ample policy space for cutting. However, there is absolutely no need to push forward into a bad news rate cut, given that growth remains so resilient. That, essentially, in a capsule, is my rationale for a 25 basis point.
Okay. So what may be your own trigger for another rate cut? Will it be if growth disappoints, or will it be if inflation undershoots?
Without question, inflation is the primary target. That's the mandate of the MPC. So I do remain confident that given the progress of monsoons that we have seen, given the global political situation, that for the next few months, at least for the next couple of quarters, we might see an undershoot of inflation given the current forecast. So that opens up space, to my mind, for further rate cuts. But that's something which has to be determined on a meeting-by-meeting basis, monitoring incoming data, seeing the macro-financial conditions that prevail at that point in time. So this is probably not the time for pre-committing on a policy path easing. It has to be done meeting by meeting and very data dependent.
Okay. Well, actually, the chances are the Reserve Bank will be surprised on the downside. The poll of economists actually indicates most of them are expecting 3.5 average inflation this year, not even 3.7. So if the Reserve Bank is forced to acknowledge that in, say, the October policy or December policy, do you see scope even beyond 5.5? I mean, like 5 quarters is a possibility?
Perfectly. I mean, actually, you're absolutely right. Beyond less than 5.5 is eminently possible. However, remember at this point in time, the assumptions behind all the forecasts, the models, the predictions, etc., these are very volatile. I mean, these are liable to change very, very quickly. I mean, if not in days, in the matter of a few weeks. So, so all of that needs to be treated with caution. We do not know how I'm not terribly worried about the current geopolitical tensions going on. I think that will settle within a few weeks' time, if not even early. So I'm not very worried about that. What I am worried about, the contours of the trade agreements that are liable to be signed, not just India with the US, all the other countries with the US, giving us a sense of the relative positioning of India vis-a-vis the US amongst our other exporting peers. That, to my mind, is a far bigger source of uncertainty, and that's something that we need to keep watch about. So, if the global growth situation begins to improve, remember the Fed forecasts a major reduction in growth in the US. If that doesn't pan out, if China growth improves, then you are actually liable to see global commodities prices, particularly metals prices, forget about oil, going up. So these assumptions are now very, very fluid, and that needs to be taken into account in forecasting the potential path of policy easing going forward.
Okay, actually, I was going to invite your comments precisely on that. We also have a very poor tax growth number, just 4% for the month of April, May. But before that, let me just complete the MPC issue. Did no one, I would have expected you to protest on the stance. I know you told us last time that the stance is not put to vote. But as a market man, you would probably better understand than even the RBI guys that when you give a 50 bips cut and change a stance in one policy, the market actually took the stance more seriously and yields went up. Would it not have been wiser to leave it as accommodative, but in the conversation or in their action, do a VRRR of a limited quantity? That did not come up for discussion? You didn't advise?
Again, I mean, let me go back to my original first statement. I speak only on my behalf, not
Yes. Yes.
So, I mean, I'm not going to comment on the discussions or the actual change in the stance. I will take you back once again to my April statement, where, if you remember, I did mention that I had a prior reservation about changing the stance from neutral to accommodative at that point in time. Okay. I felt it would have been wiser to keep the stance at neutral at that point in time, given the extreme uncertainty at that point in time. But I mean, ex post in the July meeting, despite my own vote dissent, once it became clear that the MPC was voting for a 50 basis point cut. So at that point in time, to my mind, it was more prudent to revert back to a neutral stance. Okay. Just to communicate to the market as a proxy for forward guidance that need to be very cautious at this point in time, need to be very, very data dependent going forward in the rate.
Okay.
Okay. So that was the basic rationale for agreeing to the change back to neutral.
Okay. You always were preferring that stance, you said. Don't pre-commit because we live in tense times. Just to wind up this growth argument, you yourself alluded that you are more worried about the tariffs rather than geopolitics. And that is obvious. You know, today crude prices, one would have thought with a threat to the closure of the Strait of Hormuz, it would at least go above $80. It hasn't even done that. So I take your point that geopolitics is a worry in a broader sense, but not for financial markets in an oil sense. But Saugato, there are worries about tariff destabilizing growth itself. Our exports, even in the last month of May, were flat compared to the previous year on year. And they could, goods exports especially, could take a hit. Global trade is expected to be lower. And above all, this May tax numbers are particularly a pointer that things are not as robust as the Jan, Feb, March quarter. Maybe. It is not only net taxes. It is not because people have asked for refunds. Gross taxes and net taxes are pathetic, 4% and 1%, minus 1%. So do you think, growth, the MPC members were perhaps right, growth does need help?
No, you're absolutely right. I mean, I couldn't have put it more succinctly than you've stated. I know, we've gone back a long time together. So I do worry about growth. There is absolutely, as the governor and the other members have mentioned, that this 6.5%, even if we assume that the RBI is correct, that the growth forecast of 6.5% for FY26 still pertains. And there are conflicting signals. There is no doubt about that. So some of the high frequency indicators do seem to suggest that growth impulses still remain. The actual numbers, so this is again the divergence between the soft data and the hard data. The hard data coming in with the numbers for tax collections, e-way bills, etc., do suggest that there is some persisting weakness. The numbers that we have seen for the rural wages indicate that there is some resilience coming, if not fully coming back into the rural economy. The urban economy still remains relatively stressed. So, I mean, the picture is very mixed. I do not know which way growth is going to go. No. So, each and every new data point needs to be evaluated for the growth inflation balance, the growth inflation mix going forward, and then take a call on what it is that needs to be supported. And this is the reason that I came in the beginning saying that I am now very, very data dependent looking at the incoming data, monitoring the global conditions, domestic conditions, and then take a call on what.
Okay. Okay, just a final question on the inflation number. Like you said, it could well undershoot. At least the market expects it to be less than 3.7. But as the governor pointed out, in the rate-setting calculation, next year's inflation also comes into the fray. It's a 12-month forward. And next year's, partly because of the low base, is expected to be well above 4.5. If that's the case, do you think the market should not be betting on another rate cut? Because the 12-month forward is not 3.5%. It's over 4.
Far be it from me, Lata, to try to preach to markets.
Okay.
I mean, they're far smarter than I am. But definitely, I would suggest that a rate, the neutral rate, essentially, I mean, this is where it comes down to.
Yeah.
The neutral rate should be looked at as a steady state through the cycle, not just at a point in time. At this point in time, we are fairly deeply restrictive in terms of policy, but that's not the way to look at it, as you very well know, as your readers will know. It has to be looked at over the cycle. And given the uncertainties, again, I'm mentioning, because I just do not know which way the trade deals are likely to play out, not just in India, across the world, global, I mean, all the major trading economies, how this is likely to play out, India versus the UK, EU, FTA, India versus the US, the other trade agreements that we are looking, and all the other US trade agreements. So how that evolves over a period of time, you've already seen the preliminary trade indications of the US with China.
Yes.
If that happens, we should be prepared for an increase in global metals and commodities prices. So, I mean, given these uncertainties, I agree that inflation at this point in time, using the lens of the current situation, inflation looks to be very moderate, but that can change very, very quickly.
Okay. Fair point, sir. It was a pleasure speaking with you. As always, Saugata Bhattacharya, thank you very much indeed for joining us and explaining how we should be looking at data and how the MPC needs to be terribly data dependent. That's the word coming in from a very important policymaker and MPC external member. We wrap up on Bazaar on that note. Chartbusters coming up.